What other challenges should businesses be aware of?
Another potential downside is the risk associated with customer non-payment.
Hmm. Tell me more about that.
Remember, with some types of accounts receivable financing, if your customer doesn't pay,
Oh.
you might be on the hook.
Yikes. Okay, so I need to be really selective about which invoices I finance.
That's right.
It's not just about getting the money, it's about managing that risk responsibly.
Exactly. And finally, there's the potential loss of control.
Okay.
When you use accounts receivable financing, you're essentially handing over some control of your receivables to the financing company.
So I might not have as much flexibility in, offering payment terms
Right.
or dealing with disputes and things like that.
Exactly. Those are all things to think about.
Okay, so we've covered the
Don't worry.
good,
Yeah.
the bad,
Yeah. Yeah.
and the potentially ugly. Now let's get down to the nitty-gritty. Who actually qualifies for this type of financing? Is it just for any business that needs a cash injection?
Not quite. Lenders have specific criteria they look at.
Okay.
And understanding those criteria can help you determine if accounts receivable financing is even a viable option for you.
Okay, so let's pretend I'm a business owner considering this.
All right.
What's the first hurdle? What are they looking for?
Well, first and foremost, they want to see a consistent stream of accounts receivable.
Okay.
They need to be confident that you have a regular flow of invoices coming in, not just a few here and there.
So if my sales are sporadic or unpredictable, it might be tougher to get approved.
That's right. And they're also going to be scrutinizing the creditworthiness of your customers.
Right, because they're the ones who are ultimately going to be paying those invoices.
Exactly. They want to see that your customers are reliable and likely to pay on time.
Makes sense. And of course, they'll also take a look at your own business's financial health,
Yeah,
right?
of course.
They'll want to see that you're managing your finances responsibly.
And have a decent credit score.
Right. Even though this is less about your business's credit and more about the invoices themselves,
Right.
they still want to make sure you're a good bet.
Makes sense.
Yeah.
So what else do they consider?
They often have minimum thresholds for the amount of receivables they'll finance.
Okay.
They need to make sure it's worth their while, so you usually need a certain volume of invoices to qualify.
So if my invoices are small or infrequent, it might not be the best fit.
Right. And the type of business you run can also matter.
Okay.
Some industries are considered higher risk than others, which can affect your eligibility and the terms you're offered.
So for example, like a construction company might be seen as riskier than a software company,
Exactly.
just because of, the nature of their work and how their payment cycles go.
Exactly. Lenders might also look at things like the age of your invoices,
Okay.
the terms of your customer contracts,
Mm-hmm.
and your overall business history.
Okay, so there are a lot of moving parts here.
But let's say I check all the boxes and I'm ready to apply.
Right.
What are the typical costs and fees involved? How do I even begin to compare different offers?
That's a great question, and it's not as simple as just looking at an interest rate.
Okay.
There are a few different ways these costs are structured,
Okay.
and you need to understand them all to make sure you're comparing apples to apples.
All right, let's break it down. What should businesses be looking for?
Yeah.
What are those key terms I need to understand?
Okay, one common way costs are calculated is with a factor rate.
Factor rate.
This is essentially a discount applied to the face value of your invoices.
So if my invoice is for $10,000 and the factor rate is 2%,
Yeah.
I'd receive $9,800 up front.
Exactly. That remaining 2% would be the factor's fee.
Okay.
And keep in mind that factor rates can vary quite a bit,
Mm-hmm.
depending on factors like your customer's creditworthiness,
Okay.
the volume of invoices you're financing,
Right.
and the overall risk associated with your business.
So it really pays to shop around and compare those factor rates from different providers.
Absolutely.
Is there anything else I should be watching out for?
You also need to be aware of any additional fees that might be tacked on.
Like what?
Things like origination fees, processing fees, audit fees, even wire transfer fees.
Wait, so there are fees on top of fees?
Unfortunately, yes, it happens.
Hmm.
That's why it's crucial to read the fine print
Okay.
and understand the full cost structure before signing on the dotted line.
So don't just focus on that factor rate.
Right.
Factor in all the potential fees
Exactly.
to get that full picture of what this is actually going to cost me.
That's right.
Okay, so I need to be a savvy shopper
You do.
and read that fine print carefully. Got it.
Mm-hmm.
But let's say I've done my research, I've compared offers, and I've found a few potential financing providers that seem like a good fit.
Okay.
How do I choose the right one?
Well, it goes beyond just the numbers.
Yeah.
Think of this as a partnership. You're entrusting this company with a critical part of your business's financial health.
So I need to do my due diligence and
Yeah.
make sure it's a good fit, not just a good deal.
Exactly. Start by checking their reputation.
Okay.
Look for online reviews, talk to other businesses that have used their services, and see what their track record is like.
Word of mouth can be so valuable.
Absolutely.
What else should I be looking for?
Pay attention to their customer service.
Okay.
Are they responsive to your questions? Do they explain things clearly? Do they seem to genuinely care about your success?
Right, because if they're difficult to work with during the application process, it's probably only going to get worse once I'm actually doing business with them.
Exactly. And don't be afraid to ask tough questions about their policies.
Like
Like,
what?
for example, what happens if a customer disputes an invoice?
Hmm.
How do they handle collections? What are their fees for late payments?
Okay, so transparency is key.
Yes.
I need to feel comfortable with every aspect of their operation
Mhm.
before I sign anything. All right, now let's fast forward a bit.
Okay.
I've chosen a provider. I've got the financing in place. What happens next?
Okay.
How does repayment typically work?
The most common setup is that repayment is tied to the collection of your invoices.
Okay.
So as your customers pay their invoices, the financing company deducts their fees,
Mm-hmm.
the amount they advanced you,
Right.
and then sends you the remaining balance.
Okay, so it's pretty much automatic,
Yeah.
aligned with my natural sales cycle.
Mm-hmm.
But are there any potential snags I should be aware of?
There are a couple things to keep in mind.
Okay.
First, the financing company might not advance you the full value of your invoices up front.
Okay.
They often hold back a percentage as reserve, just in case a customer doesn't pay.
So it's like a safety net for them,
It is.
but it also means I might not get access to that full amount right away.
Right. And the second thing to watch out for is something called recourse.
Recourse. Okay, that sounds a little intimidating. What does that mean?
It means that if a customer defaults on their payment, you might be responsible for repaying the advance.
Oh, wow.
Not all agreements have recourse,
Okay.
but it's something you need to be aware of
Got it.
and understand fully before signing anything.
So it's crucial to have strong credit control processes in place
Absolutely.
and make sure I'm working with, reliable customers. I
Mhm.
can't just blindly finance any invoice that comes across my desk.
You got it.
Okay, now before we wrap up this section, I want to broaden our horizons a bit and talk about some alternatives to accounts receivable financing.
Okay.
Because even though it can be a great option, it's not the only game in town, right?
The only game in town.
So what other financing options might businesses want to consider?
Well, the most obvious one is a traditional bank loan.
Right, a bank loan.
It's often the first thing that comes to mind when businesses need funding.
But I've heard those can be really tough to get,
They can.
especially for, smaller businesses
Yeah.
or those without a long credit history.
That's true. Banks tend to have stricter requirements
Yeah.
and a longer approval process.
Right.
But on the plus side, they can offer lower interest rates,
Hmm.
which can save you money in the long run.
Okay, so if I have the time to go through that whole process
Yeah.
and my business has a solid financial track record, a bank loan might be worth exploring.
It might be.
What else is out there?
Another option is an SBA loan.
SBA loan.
These are government-backed loans,
Okay.
specifically designed to help small businesses access funding.
I've heard of those, but they seem a little bit mysterious. What makes them different from a regular bank loan?
Well, they often have more favorable terms than traditional bank loans,
Okay.
like lower interest rates and longer repayment terms.
Mm,
But the application process can be quite lengthy
okay.
and it requires a lot of documentation.
So patience is key if I'm going down the SBA loan route.
Yes, definitely.
But what if I need funding quickly and I don't have time to wait for a lengthy approval process?
That's where crowdfunding comes in.
Crowdfund.
It's become a really popular way for businesses to raise funds from a large group of people,
Right.
often in exchange for rewards or equity.
It's like tapping into the power of the crowd.
Exactly.
And I've seen some amazing success stories with crowdfunding campaigns.
It can be a great option, especially for businesses with a compelling story to tell
Mm-hmm.
and a strong social media presence.
Right.
But it's not a guaranteed win.
Of course.
You need a solid plan to attract backers and manage that campaign effectively.
So crowdfunding is great for specific types of businesses or projects, but not necessarily a universal solution.
Right.
What about those high-growth startups that are really looking to scale quickly?
Hmm.
Are there financing options that are sort of geared towards them?
Absolutely. For those businesses, venture capital might be the way to go.
Venture capital.
This involves bringing in investors who provide funding in exchange for equity in your company.
So it's like finding a business partner with deep pockets.
Yeah, kind of.
But it's also a high-stakes game, right?
It is. Venture capitalists typically look for businesses with huge growth potential,
Right.
innovative products or services, and a strong management team.
So it's not the right fit for every business?
No,
Okay, so we've covered a lot of ground here.
we have.
From traditional bank loans to crowdfunding to venture capital.
It's a whole spectrum of options.
It's clear that there's a whole spectrum of financing options available to businesses,
Mm-hmm.
each with its own pros and cons.
Exactly.
The key is to understand your own needs and goals, do your research, and choose the option that really aligns with your overall business strategy.
Couldn't have said it better myself.